the FOMC two-day meeting begins. The FOMC meets 8 times a year to determine monetary policy and the benchmark Fed funds rate. Okay? Currently, it ranged from 0 to 0.25%. The Fed fund rate is the lending rate banks charge each other to borrow money overnight and serves as the benchmark for all other rates. Also tomorrow, the Consumer Confidence Report comes out. Expectations are for a reading of 30 over last month's 26 reading. This report measures the level of consumer confidence by surveying 5,000 households across the country each month. If consumers are feeling confident about the economy, they're more likely to spend money, which can lead to inflation, which can lead to future growth, and mortgage-backed securities for moderate growth, which leads to less inflationary pressure. And remember, mortgage-backed securities hate inflation. So, mortgage-backed securities generally respond favorably to a lower than expected reading. I think we're going to see a lower than expected reading tomorrow. Think about it. What is the average family saying right now? You got 5,000 families across the nation, and you're going to ask them, hey, how are you feeling about the economy right now? What do you think they're going to say? Okay, also tomorrow, the Treasury Department will auction off $35 billion of 5-year T-notes. Traders already know about this auction and have placed their bets, so the critical event is reality meeting expectations. Mortgage rates should not move on this news only. Wednesday, the MBAPA index will come out. What's this? It's the Mortgage Bankers Association Purchase Application Index. Well, what is that? Okay, that means that if the thought is the consumers have to feel good about the economy and their own finances to buy a new home. So the more mortgage applications we have coming in, the more people feel good about their own finances, how much money they have in the bank, so they're applying for more mortgages for a new home. So that's what that index means. What that's going to do to rates, we're not really sure. Okay, also on Wednesday, the GDP comes out. Gross domestic product. It's the total consumption of the production and goods and services in the U.S. The GDP declined 6.3% last quarter. Okay, we're expecting a 5% further decline in the gross domestic product, GDP index, this quarter. If it's lower than 5%, then you can expect mortgage rates to fall on that news. Okay. Also tomorrow, the Treasury Department will auction off $26 billion worth of 7-year Treasury notes, T-notes. The added supply of debt will place pressure on Treasuries to move lower in price, higher in yield, and could place mortgage-backed securities, MBS, mortgage-backed securities to follow. Okay, so this could have an effect negatively on interest rates by Wednesday. The FOMC meeting concludes and the accompanying statement is released setting monetary policy. Now, I expect there will be no change in the Fed funds rate whatsoever. Okay, the issue is in this statement right here. The focus, rather, will be on the language in this statement. Language may offer as how the Fed may respond in the future. So what they're saying here is, it's not what they say about the rate, it's what they say about what may happen in the future that may affect the interest rate. We're going to cover this on Wednesday afternoon as exactly what the Fed says and where we think the Fed's going to be moving in the future. certain recovery, economic strength, etc., would be more likely to hurt mortgage rates than to help them. Okay? Mortgages prefer an inflation-free environment with limited economic growth, so far as to persuade investors to buy bonds like mortgage-backed securities rather than stocks. All right? So we want people buying mortgage-backed securities rather than stocks and keep interest rates low so we can sell more mortgages. Okay, that's what's going on through Wednesday. Okay, now, Thursday, personal income and outlays, which is the dollar value of income received from all sources and personal outlays. Fancy word for personal spending. Following last month's decline of 0.2%, we should see a flat reading of 0% over the last period. If it's higher than 0%, which means people are spending more, mortgage rates will rise on the news. Now, conversely, the jobs report is due out tomorrow as well. We're expecting 640,000 Americans filing for first-time unemployment. This would set a 12-straight-week record at 6.137 million people on unemployment. If it's higher, mortgage rates will decline. So some people's bad news, not having a job, filing for unemployment, is other people's good news. If you're in the mortgage business, you want this number to be higher. Okay, also on Thursday, Chicago PMI, which is a survey of both manufacturers and non-manufacturers around the Chicago area that investors use to gauge economic strength. Strength in manufacturing will show signs of strong future economic growth and inflation. MBS, mortgage-backed securities, hate inflation. A reading above 50 indicates strong growth projection. I expect a dismal reading of 31.4%, following last month's reading of 35, which means MBS securities, mortgage-backed securities, will love this, and interest rates will fall on the news. Okay, now Friday, Consumer Sentiment Report comes out, a survey of 500 households each month on their personal opinions and their attitude on the economy. That's right, just 500 households across the U.S. Last month came in higher than expected, leading investors to believe the recession is over. That's probably why we've seen a rise in the stock market as of late. 500 households, okay? Also on Friday, the ISM Index, the Institute for Supply Management. 300 manufacturers on unemployment, new orders, and overall strength in manufacturing. I expect a low reading following last month's 38.3% reading. Listen, these are based on a reading of 50. Over 50 is bad. Had a 38.3 reading last month. I expect the reading we should see around 36. Manufacturing, no one's buying anything. Why are they manufacturing anything? This reading should be low. This is good for mortgage-backed securities. Also on Friday, factory orders report. Increasing orders is bad for mortgage-backed securities. I expect another decline following last month's decline, which is also good for mortgage-backed securities. So all in all, in the week, wrapping up, I see rates staying steady or even on a slight decline. We covered a lot. I know it's a lot to find out about. You can visit our webpage. I'm the Mortgage Czar, Roger Slalian, at www.metamerica.com.